Good day, everyone, and welcome to our Victory Virtual event this afternoon, Investment Opportunities in Volatility. I hope everyone is having a great Wednesday, and I'm so grateful that you have chosen to spend some time with us this afternoon. So I just want to spend a moment going over our agenda. We're going to be talking about a little bit of investment perspective, and then we're going to have some analysts speaking about the equity and fixed income markets, followed by some Q&A at the end of questions that you all have submitted at the beginning of your registration. Just want to introduce myself. My name is Derek Cattell. I am head of sales for the direct investor business. Joining us today is also Thomas Ullman, investment analyst for Victory Solutions, a West Point grad and Army veteran. Also returning to join us today is Jim Jackson. Jim is head of our fixed income portfolio management here with the USAA investment franchise, and is also a Naval Academy graduate and veteran of the U.S. Marine Corps. So thank you, gentlemen, for joining us this afternoon. Really appreciate your time and looking forward to your insights. So just to touch on for a moment of who we are at Victory Capital, we're a diversified global asset management firm with $178 billion in assets under management. We are publicly traded on the NASDAQ exchange. Our ticker is VCTR. We serve clients ranging from individual investors like yourselves to financial advisors and institutional pension plans, all with access to the same investment expertise. A couple of things that I wanted to touch on as that are now available is we do have a bonus program. So the bonus program works two ways to receive a bonus. If you open open a new account with a qualifying product, you can receive a bonus that way. Secondly, if you refer your friends and family, you can both get rewarded as well. So go to vcm.com/bonus for more details. I also want to touch on our Bonding Over Bonds program. It is a monthly update featuring Jim Jackson and his colleague Kevin Causey. Look for your next episode on YouTube or LinkedIn coming soon. So shifting gears for a moment, I just want to touch on a little bit of investment perspective and some things that we're hearing here. So embrace uncertainty. There's been a lot of focus from the financial media and a lot of focus on bad news, global events, and of course, volatility. So the good news to that is that's nothing new. Investors have faced volatility in the past. Historically, investment markets have dealt with things like the U.S. Civil War, the Great Depression, and Black Monday back in 1987. And when faced with volatility, some investors react by selling out of their positions and wait for things to settle down before they re-enter the market and kind of reestablish their investment positions. And while we don't know the future, what can we learn from events in the past? I think one of the important things to learn from that is just to keep things in perspective. So, for example, focus on your investment goals long term, not necessarily the day-to-day events that you're seeing in the news and financial media. By shifting your focus down the road, that really helps as a reminder to what you're investing towards in the first place. Secondly, would be assess your risk tolerance. If you're not able to sleep at night because of your investments, that's a concern. And so one of the things that you can do is work with your Victory representative here to help assess, are you taking an appropriate amount of risk? And I'd say something that's really important in assessing your risk tolerance is your time horizon. That's a really big factor. So for example, if someone is buying a house in a year or two, they're going to have a very different perspective on risk than someone who's looking to retire in 25 years. And both of them will be different than someone who is investing for their heirs and their estate. So to better illustrate this, take a look at this slide. So this is using the S&P 500 index as a proxy for the US stock market. And as you can see, this goes back to 1990. And you can see there's several events that have impacted performance of this index over the past 30 plus years. Just a couple examples would be the Great Recession in 2007 to 2009, the COVID crash that we experienced in March of 2020, and more recently, the invasion of Ukraine. And one of the things that you can see is with a longer term time horizon, you can see the resiliency of the investment markets over time. Now, as we discussed earlier, when faced with volatility, some investors have sold out and waited. And as you can imagine, that can have a significant impact on your returns, as we'll illustrate here in just a second. So One thing to keep in perspective here, pardon me, is this is a hypothetical $10,000 investment in the S&P 500 going back to 2006. So with this assumption, let's assume that this investor invested $10,000 in the S&P 500 index in 2006 and never adjusted it. So one thing to notice is if this hypothetical client stayed fully invested in this hypothetical investment, they will have received a little bit over a 10% return, and their $10,000 investment is now worth $45,000. But if they had done what we had mentioned earlier, which is to try to time the market and try to come out of the market to go back in, let's assume they missed just the 10 best days. Their return gets cut in half from over 10% to just over 5%. And the return goes from over $40,000 to $21,000. And again, hypothetically speaking, if they missed the 20 best days, their annualized return goes from 5% to 1.6%, and the return is now just $12,700. So again, this is purely hypothetical, but one thing to note is no one knows when the best or worst days will be. Unfortunately, we don't have a crystal ball, so that's where consistency is really important in your investing, because we don't want anyone to miss the important days. So what are some things that we can do to help in these uncertain times? And there's really 4 things that are important. One is assess your risk tolerance. Like I said before, is if you're not able to sleep at night because of the risk that you're taking, then potentially you're taking too much risk. So work with your representative here at Victory Capital, and they will help you assess that risk tolerance. At the same time, you could be taking not enough risk to try to achieve your long-term goals. Again, your time horizon then becomes really, really important. Diversification. For example, if your investments are concentrated in a single asset class, like for example, growth stocks, events can have an outsized impact on your portfolio. Also, different asset classes like stocks and bonds do typically perform differently depending on market events. It is not uncommon for the same market for stocks and bonds to react differently to the same market event. Third, automate your investments. So this is the term you may have heard, dollar cost averaging or an automatic investment plan. It's a way to remove emotions from your investing. So similar to like what you would do if you have a 401k, for example, where you set the amount and the frequency and the investments that you want to invest in, just like you do with any other retirement plan. Then you can then review that portfolio and review that automatic plan to decide, should I increase this as circumstances warrant? And lastly, it's an investment cliche, but in this aspect, it is very, very true, which is one of the best factors to help with your investment goals is time in the market, not timing the market, because trying to time the market it's very difficult, and keeping your focus on your goals versus day-to-day events in the market can really help maintain your perspective for the long term. So with that, I would like to throw this over to Thomas Allman, who is an investment analyst with our Victory Solutions team, talking about the equity markets. So Thomas, good afternoon, welcome.
Good afternoon, Derek. Thank you for having me, and thank you everyone for tuning in. A little roadmap on what we're about to hear. I'm going to talk about the why behind what happened in the markets, specifically talk about the equity market performance. Jim's going to talk about the fixed income market performance. We'll talk about what we're looking for the second quarter and into the rest of 2022 before talking some investment ideas and answering any questions that you have. So let's dive into what happened in the first quarter. And there's a lot of factors that come together that affect global markets, but we've highlighted 3 key drivers of investment performance, and we're calling them the 3 I's. We've got inflation, interest rates, and the invasion. So the most recent consumer price index increased 8.5% over the last 12 months, and that's the highest increase since 1982, 40 years. The CPI is based on the price of a basket of goods and services, but we've seen these price increases happen every day, at the gas pump, at the grocery stores, or when we're out at shopping. And so what is happening in response to this inflation? And that brings us to the second point, which is interest rates. The Federal Reserve has a dual mandate. They try to maximize or create maximum employment and then low and stable inflation. And so the Federal Reserve raised their federal funds rate by 0.25% in March. And that's their way of trying to lower inflation. Now, they've also indicated that there's going to be more rate increases throughout 2022, and they're also going to end quantitative easing, which means that they're going to begin tightening their balance sheet. And so that's been happening throughout the quarter, but midway through, in late February, we saw Russia invade Ukraine, and that invasion created uncertainty across global markets. And that's despite the Russian economy only being a small fraction of the global economy, but that uncertainty had a profound effect. The invasion exacerbated rising food, fuel, and fear concerns. And so I know that's a lot of heavy information, and so let's look at 3 positives that are going on right now. For the first time in 2 years, we're not talking about COVID, and that's a huge deal. The unemployment rate has steadily declined since the pandemic began, and that's also great. On the economic side, we've seen corporate earnings come out strong in the first quarter. So now let's talk specifically about market performance across the equity markets. So the major market indexes generally declined in the first quarter, except for a few, such as raw materials. And so if we're starting at the bottom of the graph, you've got US large cap, which is represented by the S&P 500 index, was down negative 4.6%. It's important to note that at its lowest point during the quarter, the S&P was down over 12%. So it has rebounded even from early March to the end of March. The next 3 indexes were also down lower than the S&P 500, and that's the US small cap, which is going to be represented by the Russell 2000 index. The international markets, which are more mature capital markets, is represented by the MSCI EAFE index. We have emerging markets, which is the less mature capital markets, is represented by the MSCI Emerging Markets Index. And then you've got this giant positive. Commodities, represented by the Bloomberg Commodities Index, was up 25.55%. And so what are commodities? Like we've said, they're raw materials. That includes energy, metals, and grains. And they've done well for a couple of reasons. First, as the economy's reopened, as inflation has increased, there's been increased demand. People are trying to use those raw materials, whether they're building houses or throughout any type of application. They're also frequently seen as an inflation hedge. And the last thing I'll point out before Jim goes into detail on fixed income is the Bloomberg US Aggregate Bond Index, was also down in negative in the quarter. And historically, fixed income has been a diversifier for equities. In periods of rising interest rates, that correlation does increase between stocks and bonds. And with that, Jim's going to walk us through the fixed income markets.
Thank you, Thomas. The broad U.S. fixed income markets declined during the first quarter, as represented by the fixed income indices shown. The Bloomberg U.S. Aggregate Index fell 5.9%, the largest quarterly decline since the third quarter of 1980. Negative returns in fixed income are not common. Since 1976, there were 42 instances of negative returns over a quarter for the Bloomberg US Aggregate, which was 23% of the time. If we extend the return measurement period to 1 year, measured at the end of each quarter, there were only 21 instances of negative annual returns, or 12% of the time. When we extend those returns out even further over a 3-year period, there were only 2 instances of negative returns, which was 1% of the rolling 3-year period since 1976. I would also point out that those 3-year negative rolling returns were only minus 0.03% in the third quarter of 1981 and minus 0.7% in the first quarter of 1980, each less than 1%. There were 2 primary drivers of fixed income returns during the quarter: higher interest rates and higher credit spreads. Credit spreads are the additional compensation received by investors to take credit risk. When yields increase, then the price of a bond declines. So this quarter, we saw Treasury yields increase, driving Treasury bond prices lower. Yields on corporate bonds, which consist of the Treasury yield plus the credit spread, also increased, driving corporate bond prices lower. You will see on the next slide this is the returns during Fed rate hike periods of the Bloomberg US aggregate. We think it's instructive for investors to consider the performance of fixed income during past Fed rate hiking cycles. The common assumption is that fixed income does not perform well during a rate hike cycle. However, fixed income markets have historically tended to price rate increases into the Treasury curve in anticipation of the Fed increasing rates. So when the Fed has historically started hiking rates, the market has already priced in current expectations. We looked at the previous 5 Fed rate hiking cycles, which are defined as the time period from the first rate hike until the first rate cut, and the performance of fixed income as measured by the Bloomberg US aggregate during these cycles. In each instance, the fixed income market had positive returns during the rate hike cycle. We see this performance dynamic for 2 reasons. First, the market anticipates Fed rate hikes with interest rates increasing prior to the first rate hike. The Fed only directly controls the federal funds rate, which is the overnight rate at which banks lend to each other. But other interest rates tend to price in expected increases, and you see the price impact on bonds prior to the first rate hike. Second, when interest rates increase, we see bond prices fall. However, investors will also start earning a higher yield on reinvested income. The starting yield is the primary determinant of fixed income returns over time for investment grade bond portfolios with stable duration. As fixed income investors, we are encouraged by the higher rates because we think it has the potential to improve returns to fixed income. So what should you be watching for in the second quarter? We think there are several things. Does the geopolitical risk environment improve? Specifically, do hostilities cease in Ukraine, and how long does the sanctions regime persist? How do oil and natural gas prices change in the coming quarter? This clearly has an inflationary impact, but energy prices also impact consumer spending. Do we see inflationary pressures start to ease, or do they persist at the highest levels we have seen in 4 decades? And finally, how do all of these factors impact Fed interest rate policy? Does the Fed hike more aggressively to tame inflation? And what are the risks to economic growth? I would like to invite Thomas back to the screen to discuss opportunities in today's market.
Thanks, Jim. So as we look at what are opportunities right now, let's remember that investing involves risk and markets can be unpredictable. So even a well-diversified portfolio measured by the indexes we talked about earlier was down in the first quarter. With that said, though, the foundation of sound investment management starts with owning a diverse set of investments. And there's a lot of ways to look at that. So we can diversify with equities and fixed incomes. Those are stocks and bonds. We can look at it across market cap. So we've got large and small. We can look at it geographically where we have US, international, and emerging markets. And another way to do it is looking at style. And so the style has growth, core, and value. And the growth stock valuations are going to typically rely on expected future cash flows. And so in rising interest rate environments, those future cash flows are going to be worth less. Whereas the value stocks typically have stronger current cash flows and they trade at a discount to their fundamentals. So having those value companies can make sense in inflationary environments. Another way to diversify is looking at the source of the return. So a stock's total return comes from the capital appreciation, that change in share price, and then it adds on the dividends or the distributions paid to shareholders. So companies that pay dividends are often value stocks too. So there's an overlap between what we just talked about. Jim's going to talk about the fixed income opportunities.
Thanks, Thomas. We still view fixed income as a time-tested portfolio diversifier with a place in most investors' portfolios. Fixed income returns have less year-to-year changes than we see in equities. For example, the worst one-year return in the S&P 500 is more than 30 percentage points worse than the worst one-year return in fixed income. And the worst 3-year return in fixed income is only minus 0.7%, while the worst 3-year returns of the S&P 500 is minus 17.4%. Fixed income also tends to correlate lowly with equities. Also, fixed income also provides a valuable income component to your portfolio. And finally, we think investors should be careful to manage their interest rate risk consistent with their risk tolerance. Thank you for listening, and I will pass it back to Derek for questions.
Thank you, Jim. Thomas, appreciate your insights so very much. And I think that was really helpful. So we do have several questions that we have received during registration and from some other sources, folks submitting live that I wanted to touch on. So Thomas, the first question I'd like to pose to you, which is, can you go a little bit deeper on specifically on Russia? Can you touch on how Russian equities have affected any of our portfolios and what kind of where we go from here?
Yeah, absolutely. So Russia was categorized in the emerging markets, so funds with exposure to emerging markets, some international, depending on if they're only looking at developed markets. There might be a little overlap there too. But what has happened is that the index providers, so anything that's following an index, the index providers have eliminated their exposure to Russia. They've dropped those securities. However, the actual funds themselves, because in response to the sanctions, the Russian government and the Russian banks closed off foreign investors, they have made it impossible. It's not possible for our firm or any firm to be able to trade those securities. And so we continue to monitor the situation. We receive updates every day, but that's what's happening right now. It is not possible to trade those Russian securities, and it's very important to us to stay on top of that, and we'll keep everyone updated as we learn more.
Great. Thanks, Thomas. Jim, it's kind of same question to you. Has Russian bonds affected any of our portfolios?
Thank you, Derek. No, they have not. Our team, we have a fundamental credit research team that looks at the underlying credit quality of the bonds that we purchase for our portfolio. We do not hold any Russian sovereign bonds, and there was no impact on our performance.
Great. Thank you. Continuing with you, Jim, one of the questions we received as well is, with market volatility, rising rates, and threats of inflation, can you touch on municipal bonds, and are they likely to hedge inflation?
Sure. The muni bonds had a difficult first quarter, as did the rest of the fixed income market. The first quarter of 2022 was the worst performing quarter for munis since the early 1980s. However, I would note that the last 2 rate hike cycles have resulted in positive returns for the muni bond space. I would also note that the flip side of rates going up and bond prices going down is that you will start to earn higher yield on your existing holdings, and the yield will tend to drive performance over time. What we've also seen as well is that the credit quality of the underlying muni issuers has in general gone up, and there are several sort of reasons for that, mostly driven by federal money coming into munis and also higher tax receipts from strong economic growth. So we see munis offering, if it fits in investors' portfolio, reasonable return for the risk involved. I would say that the tax exempt yield on the muni bond index using the highest tax bracket is 4.39% at the end of the first quarter.
Great. Thank you, Jim. Quick follow-up with you as well, since we're talking about some more specific areas of the fixed income realm. Can you also touch on the risk specifically in short and ultra short-term bond funds?
Sure. The risk in short and ultra short bond funds is the same risk that you will see across the entire fixed income space. Where they differ is in magnitude. So short term bond funds and ultra short term bond funds will have less interest rate risk than intermediate or long term funds. So you will have a more muted price impact for any given level of interest rate increases. So if we look at the Bloomberg US aggregate performance in the first quarter, that is an intermediate term broadly cited index, it was down 5.9% in the first quarter. The 1 to 3 year portion of that index was down only 2.5% for the quarter. So as you can see, even though rates were up more in the shorter end of the curve, the lower interest rate risk embedded in those products resulted in a more muted price impact.
Great, thanks, Jim. Question for both Thomas and Jim is, I know everyone's individual investing circumstances are unique, but can you touch on some asset classes that do well in an inflationary environment? That I know inflation is something that's on a lot of people's minds right now. It's getting a lot of headlines. Can you touch on some asset classes or some areas that do well in inflationary times?
Yeah, I can lead off on that. On the equity side, we talked about it earlier. We have seen those value stocks historically outperform growth stocks during inflationary environments. We saw in the first quarter those commodities did very well, but it's really important to remember that each environment is going to be different, right? There has been inflationary pressure, but we also had the invasion of Ukraine. So it's hard to draw too many things and say, with any type of crystal ball, this will do well or this will not do well. What I would say more generally is a well-diversified portfolio that matches an investor's risk tolerance, time horizon, and goals is the fundamental building block to portfolio construction. So you have to make sure it works for you. Jim, I don't know if you have anything to add.
Thomas, I would echo that last comment. I would also add that in the fixed income space, over time, there has really only been one type of security that was a hedge against inflation, and those are in inflation index bonds such as TIPS. However, there is a cost to that. Those bonds will outperform a nominal treasury only when inflation is higher than expectations. If it is less than expectations, they will not. So it is pretty much a bet on whether inflation currently exceeds what it is expected to be over the time period of the bond. So I again would echo Thomas's sentiments, and that the best protection against inflation is a well-diversified portfolio that you stick with through time.
Gentlemen, thank you for that. And that kind of answers the next question that we received as well during registration, which was best strategies to build into portfolios to offset market drops. And a follow-up question that we received to that I wanted to spend a moment on, and then if you guys want to jump into that, that'd be great, which is, should I change my asset mix, meaning bonds to stocks, based on risk tolerance? And I would say, quite honestly, the answer to that is it depends. It goes back to what Thomas had talked about, I had talked about as well, even Jim had talked about, which is, what is your time horizon? What is your risk tolerance? You know, I used the term a couple of times. What is are you able to sleep at night? All that being said, there are ways to adjust a portfolio without completely changing your overall allocation. So just as a hypothetical, let's say someone is 50% stocks and 50% bonds. And in the stock portion of the portfolio, that was really aggressive asset classes. And on the bond side, they were on the long-term side. So you can still maintain a 50-50 portfolio allocation, but you can go from a really aggressive funds to maybe, as Thomas suggested, maybe something that has a dividend growth, or maybe something that is more value oriented and is less aggressive in its investment strategy. Same thing on the fixed income side. Instead of going for long term, maybe look at more at your intermediate or short term. But I would say the appropriate answer is it depends. Reach out to your representative here at Victory Capital, and they can help ascertain if you're on the right track. And I will say one other thing on that is, a follow-up is, should I change my asset mix, is have you rebalanced? Were you originally a 50-50 investor, but due to market conditions, you're now 70-30? And so if that's the case, rebalancing to get you back to 50-50 may be an appropriate course of action. But again, reach out to us at Victory Capital and we'll happily work you through your individual circumstance. One last question that I wanted to touch on is something a little bit different. And so Thomas, if you could touch on this, is can you spend a moment just talking about the volatility and what's been transpiring in the cryptocurrency markets, please?
Yeah, absolutely. So crypto is interesting, and I think that we're asking it on a phone, on a webinar with an asset manager speaks to how it's changed, right? So as an asset class, crypto has had more volatility than major stock indexes historically, but we've seen broader acceptance and we've seen institutional adoption. And with that, we've seen coupling to traditional markets. So we've seen the fear and uncertainty happening across some of our higher growth, more aggressive options. And it's not a surprise that we've also seen that volatility also in the crypto markets. Outside of that, I think we've seen a lot of news generated by crypto, whether it be NFTs, will products be allowed to be used, where are crypto coins being used right now, that has also generated volatility outside of just a traditional asset class.
Great, thank you, Thomas. I just want to have a couple last comments here as we wrap up. We received lots of questions as folks had registered, but they were more personal and unique. So I wanted to let you know that if we did not address your question here, we will have one of our representatives reach out to you to go over your personal circumstance and do our best to answer the question that you reached out to us during your registration process. That being said, so very grateful that everyone took their time to join us today. Please reach out to us at 800-235-8396. You can always also find us at investor.vcm.com. I hope everyone has a great rest of your Wednesday. Thank you so much. Thanks for joining us, and we'll see you next time. Take care.